We just wrapped up our commercial real estate for beginners panel here at Bpcon 2023. I was able to share the stage with some awesome investors covering everything from how to get started in commercial real estate, the current state of the market and why it actually might be the best time we've ever seen to buy commercial properties, and how to find a mentor so that you can do this yourself. Now, I know that the video is incredibly long. It is the full entire panel discussion that we had here. So just check the chapters in the bottom if you'd like to skip around, but let's dive on into it.
You're at the right place. This is how to get started in commercial real estate investing. And I'm going to let everybody introduce themselves. We got a great panel here. I won't have to say much, hopefully. So Tyler, jump in.
Awesome. I'm Tyler Cauble. I'm a commercial real estate developer out of Nashville, Tennessee. We've got a little over $50 million in assets under management, and we focus on mostly mixed use. We've done everything from food halls all the way up to master plan communities with 1,100 multifamily units, office, retail, all the fun stuff. I started off as a broker. I've got a property management company as well. So we kind of bring a wide berth of knowledge in commercial real estate.
Hi, everyone. My name is Brittany Arneson, or Investor Girl Brit, if you follow me on Instagram. But that's been a big part of my story. And I've been in real estate investing for 12 years now. Started in the single family homes. My first house was $25,000, kind of in the middle of nowhere in Canada, and then did a whole bunch of flips and work on the properties myself, built up this Instagram thing, met a whole bunch of these incredible people at a conference in 2019, and it completely switched my mindset from residential, small, single-family homes to commercial real estate. So I bought my first apartment building in 2019, doubled my income and portfolio overnight with that one deal, and then it was just clear to me that was the path I wanted to head in. So do a bunch in self-storage, do a bunch in multifamily, and bought a boutique hotel in Belize. So there's a bunch going on.
Hey, everybody. I'm AJ Osborne. I'm from Boise, Idaho. I do just self-storage. I don't do all sorts of cool stuff. I got about over $300 million in assets, and we focus primarily on all the functionalities of the business. So I own a portfolio of companies underneath that. I'm sure a lot of you know vertically integrated. We think of it as universally integrated, which means we have services that go in and out, including tech, architecture. We have all sorts of stuff, about 10 companies under those umbrellas. With storage, and our primary focus was acquisitions, but then we turned into developers, and we lead the way in the industry in both technology, but also specializing in creative solutions with asset types like converting bankruptcy for Kmart's, which a lot of people have probably heard about now, and office buildings, as well as creative structures and financing within that space. So.
Hey everybody, my name is Jay Scott. I'm a multifamily syndicator at Bar Down Investments with my partner Ashley Wilson. I live in Sarasota, Florida, just about 2 hours west of here. So if you drive west, when you hit the water, that's where I live. We have about 130 million assets under management in the multifamily space. Well, that was last week, probably 128 million this week, 27, 26, 25. So most of our assets are in the southeast and south, and that's us.
All right, so I'm Paul Moore. I'm a failed multifamily syndicator who jumped into a commercial real estate fund. We actually saw a real need for our investors to be diversified across a different asset types, geographies, operators, et cetera. So we pulled back about 5 or 6 years ago. We started a fund. We have 6 funds. We work with accredited investors who invest with us, and then we spread it out over 7 different asset types, including self-storage, mobile home parks, RV parks, multifamily, light industrial, retail strip centers, and a single-family home portfolio as well. So I've got a question. Jay, I did a Twitter poll the other day, and I asked, what do you think are the most important factors in valuing a commercial real estate property? Is it location, building condition, net income, or cap rate? And virtually nobody said cap rate, but a lot of people said location. Jay, you just said that your value is dropping, but your location's not changing, your building condition's not changing. How is commercial real estate valued?
Yeah, so, and this is an important point. When you look at valuations of commercial real estate, it really is just two things. It's the amount of income that you're pulling in, and then this thing called a cap rate. And for those who aren't familiar with cap rate is basically just a multiplier in a particular market for a typical type of property that will get you to that valuation. And the formula is the value of your property is somewhere around the income that the property generates divided by this multiplier. And so as you can guess, that numerator, the income of your property, that might change a little bit over time. So maybe your rents go up, maybe your expenses go up a little bit, maybe your vacancy goes up and down. So that number can go up and down. But when you're talking about the multiplier on the bottom, it's a percentage. And so we think of cap rates as 4% or 5%. That's how we measure these multipliers. And it's not uncommon these days for these multipliers to go from 4.5% to 5% to 5.5%, or maybe the other way in some markets. But to give you an idea of how sensitive the value of your property is, when you're talking about a cap rate of, let's say, 4% as your denominator, basically that values your property. When you divide by 4%, that's the same as multiplying by 25 times. So in a market where a property has a cap rate of 4%, the property is worth about 25 times whatever the income that it's bringing in. Now, let's say that cap rate, that multiplier, goes up to 5% in that market, and that's not uncommon for what we've seen over the last year and a half. For a 5% cap rate, that's equivalent to multiplying the numerator by 20 times. So if you have a property that brings in $1 million, having that multiplier go from 4% to 5% basically has taken the value of your property from $25 million to $20 million. Literally, you've lost $5 million in value, even though your income hasn't changed, even though your location hasn't changed. Maybe nothing has changed other than the fact that that market, buyers are less willing to pay the same premium that they were a year and a half prior.
So AJ, I look at you as, that's great, by the way. So the location and building condition in my Twitter poll, not so much, right? Although they could affect that a little bit, Jay, right?
Absolutely. And typically when we talk about location and building condition, these are the things that are going to impact how much the cap rate moves. So if we have a location that's softening tremendously, let's say a location think about places where population's leaving, California, New York, other parts of the Northeast. When people are leaving, buyers aren't going to be willing to pay the same premium. So that location, the cap rate's going to go up, the multiplier is going to go down, and your property is going to lose value, even though, again, your income may not be changing. Condition, the same thing. When you have a property that's in not very good condition in a market like this, you have a lot of buyers who feel like they can get nicer properties for the same price, so they start to overlook those properties that are in more distressed condition, and the multiplier that we use for those properties tends to change as well, and so the values go down. So location and condition are certainly a factor, but they're a factor because they impact that multiplier, that cap rate.
AJ, can you explain forced appreciation with regard to what Jay shared? Why do people say we can force appreciation? How does that work?
This is a topic that I've been obsessed with for a long time because real estate investors made no sense to me. I thought they were all crazy. Business made sense to me. There's intrinsic and extrinsic value, okay? Intrinsic value is just purely what you get. So if I pay $1 million and I get $100,000, the intrinsic value is that $100,000 that I receive. Extrinsic value is things like cap rates, right? That is a value that the market's putting on that property that doesn't necessarily have anything to do with the income or that property, meaning that it can fluctuate because, like Jay said, supply and demand of them, not the asset. So forced appreciation and that intrinsic value is what we focus on, meaning that I can buy this for $1 million and then it's making $100,000. That's the actual value that I get. Now, how can I change that value? I can increase that net income, and I can do that through business operations, through management, through actual value add, through CapEx, all sorts of different things. We focus a lot on the operational side because that's a lower capital impact, meaning there's lower capital that's needed to be invested, but lots of times you get the same or more impact from the operational side. Now, the reason why we focus that is because that is how we can control value regardless of what the market says, like Jay. So like when Jay said, some demand, the investors may not want it anymore. Well, if I raise it from $100,000 to $200,000, that is how I hedge against that 4 to 5 cap. Now I've erased that impact because the net income doubled. So even though it went from a 25 multiple to a 20 multiple, I'm still getting way more out of that property. That hedges against banks needing to refinance. That hedges against all sorts of market conditions. And frankly, it's the only thing you can do to hedge against those outside forces. It was a way for me to try to get rid of the risk in the market by making sure that the market wasn't in control, but we were. So intrinsic value is how you hedge against extrinsic forces that you don't control, that keeps you up at night and may scare you. It's also the only thing you should focus on, because you can't control it, to assume the market is going to make your properties just worth more, which that's standard real estate investing. That was ludicrous to me. Listen, I believe in praying, but not when it comes to investing. I don't expect God to make my property worth more, right? So I don't like that. I don't like that methodology. I want a plan. I want it to be measurable, and I want to see exactly where that value can go from things that I control. And then with that, I can build systems and processes. Then I can stack, and I'm not sitting here going, oh man, if the market turns on me next year, we're in big trouble. No, it's if the market turns on me next year, I'm going to buy more.
So in the residential realm, which all of us have been involved in at some point, and many of you have as well, the properties are valued based on comps, comparables, other properties in the market. So when my son and I fixed up a house we bought for $115,000 and we added $150,000 in improvements, those gold-plated fixtures were dumb. But in a neighborhood where, we spent, let's say it was $300,000 in a $250,000 neighborhood, that doesn't work. But in commercial property, you can increase the income, like AJ said, and you can potentially outrun the cap rate expansion, if you will. So AJ, can you just briefly, mini case study, how, you mentioned going from 100 to 200,000 in income. Can you just give a mini case study on a deal like that?
Yeah, absolutely. So that's vastly all our deals. So over a 10-year horizon, our average internal rate of return, including a capital event, which is not selling, only refinancing, we average over 40% on all our deals. And so when we buy it, we measure it. So what I do is I take the operations, I take all the rent rolls, I take every single customer, I look at the total expenses on there, but I'm more focused on revenue. And what we do is we then survey marketplace and we look at quality to rents, and we start to look at gaps and holes that are missing. I call this money on the table because I can see it. The owner's just not taking it. So we've had properties, if you look at one of our properties that we took over, it was great condition. It was an okay location, everything else. The owner was a good owner. The property looked good. He kept things tight, but he just wasn't operating it really fine and in line. And we were able to take that, what was $90,000 net rent, to roughly 200 to 250 in a single year with zero capital put into to have to remodel, to have to do anything. We immediately refied 3 years later, and we took 150%, 100% of our money back. We got a 50% return, and the property still cash flowed more than we had bought it just 2.5 years prior.
Britt, I think everybody here wants to know, if I'm going to jump into commercial real estate, what would be the perfect property type? What would be a good property type and methodology to get into that? Can you speak to that?
Yeah, well, and I think we're all different, right? Because in multifamily, it was an obvious choice for me because I was in residential doing rehabs myself, and I could understand it. So it's just like, okay, it's one house, but instead of just one house, there's 15 little units in one building. I can handle that. I can go from that, and it made sense. But then there's also like self-storage, where it's the heavy business side of things. So if you understand how to operate a business and how to turn around a business, that makes sense for some people. And that's what I liked about self-storage too. I'm like, I could see how it makes sense. If you go in and you have a mom and pop owner that don't answer the phone and they don't have a website and they don't have all this stuff, okay, you could go in and make a website, get people to the facility and turn it around that way. So I think it's just really whatever speaks to you, and then what makes sense with your previous skill set as well, and then just going for it, because it's all shiny object. There's so many cool ways to go within commercial real estate, but you kind of have to put blinders on at a certain point and just go in one direction.
Can I add to that?
Yes, please.
There's always this sentiment in commercial real estate where one asset class is, the worst asset class you could possibly buy, right? Like 10 years ago, retail. Who owns retail? Retail's dead. There's no point in buying retail. It's a terrible investment. For the past 3 years, it's been office. Office is a terrible investment. Don't buy it. Nobody works from the office. Whenever I hear things like that, I dig into it further because it's not true. People like to listen to the headlines and they like to say, oh, okay, office is dead. Let's just stop buying office assets. I hear that and I'm like, cool, office is on sale. What can we convert it into? Right? So, pay attention to it. There's no bad asset class in commercial real estate. They're just all different. And so it completely, like Britt was saying, it just depends on your investment style, what you kind of want to do. And as long as you buy it right, you're probably going to be fine.
Yeah, Britt talked about mom and pop owners. I was actually in Fairbanks, Alaska, looking at a mobile home park with 200 spots, so not a small one. It was listed on Google Maps as an RV park. Across the street from it directly, there was a handmade sign for a self-storage facility, and I called the number on it, and the voicemail said, hey, this is Susie's portable yoga and massage business. I'm probably somewhere in the Alaska wilds, so I'll get back to you next week or 2 or 3. I mean, an opportunity to buy a place like that mobile home park, which we did, or the RV or the self-storage, it has a lot of, AJ talked about intrinsic value. Sort of like Michelangelo, I don't know if I'll get the quote right, but the greatest sculptor of all time, or at least the most famous, he said, when I see a block of granite, I see an angel trapped in the granite. I just have to chip away all the extra stuff and get down to the angel. And that's what intrinsic value is. AJ can see value, and a lot of us can see value in assets that you wouldn't otherwise see. And some of that value might be in adding marketing or signage, or it might be even putting a cell tower on the back of the property or something like that. Tyler, you recently, are you under contract or are you buying a self-storage facility? Can you talk about some of the intrinsic value in that property and how you're going to upgrade that?
Yeah, absolutely. So this is a deal that's about an hour outside of Nashville, right off the interstate. Self-storage is a very attractive investment. I don't own any self-storage. We've looked at developing a number of them. We just haven't done it yet. But what attracted me to this site was that it has a flex building on it. And if you follow me on YouTube or my podcast, I'm really big on flex space right now. And it's a 6,000 square foot flex space. It's currently occupied by the owner who's going to be vacating it once he sells it. And he's not renting it to himself. So there's no value in that building outside of the intrinsic cost per square foot of what the building would cost. So we've got it under contract for $900,000. Which is basically, a 6 or 7% cap rate on the 30 occupied self-storage units that are there. So doesn't sound like a great opportunity, right? At least from a value add investor's perspective, but it sits on 11 acres. So we can build 180 more self-storage units there and 40,000 square feet of flex. And we just need to lease up the 6,000 square feet of flex that's currently there. It's going to be cash flowing day one because we got creative on the financing. We're bringing $400,000 down. The seller's going to carry $500,000 as a seller's note, so we don't even have to deal with a bank. 5% interest only for 5 years. He's really cool with that because he's like, oh, you're going to pay me more than what I bought this property for in cash day one, and I get to collect 5% every month for the next 5 years. I mean, he's making like another $125,000. So we just framed it that way for him, and he was like, oh, that's great. I get mailbox money. And we told him, like, look, you can foreclose on it if we ever default. So basically, it's a win-win situation for him.
So what's going to be the land cost on your additional self-storage units?
Yeah, basically zero, right? Because we're putting all of the value on the existing self-storage units. That's why I'm saying it's like a 6% cap rate for the existing self-storage. The land's essentially free.
Right. So this is an opportunity. I mean, Tyler might be able to put a billboard there and rent the billboard out. He might be able to put a cell tower on there, and cell tower leases are very valuable. There's I saw one self-storage facility that had an ATM out front, another one that had a propane filling station. So there's all kinds of value adds you can do in all kinds of asset types. I know of a mobile home park that put a 1 acre storage facility out front. They had an acre out front. They couldn't get approved for any more mobile homes, but they noticed there were a lot of cars, extra cars, the kind I'm talking about up on blocks, right? And RVs and boats in this mobile home park. So the new owner came in and said, hey, this place is so cluttered up. So they said, okay, if you have any more than 2 cars, you've got to move one. So they built this. They took 1 acre out front. They paved it, put a fence up, a really nice gate. And they said, okay, you now have to put your extra stuff, the work truck or whatever, in there, and we're going to charge you. So they're charging, it cost them $100,000 to pave and put the fence up. They're charging $10,000 a month, free and clear, because there's no cost to the land or to the operations. That's $120,000 a year they're making. If you divide the $120,000 by, let's say, a 6% cap rate, going back to Jay's formula, 0.06, I think that's $2 million in added value they created by spending $100,000. That's intrinsic value. That's very, very powerful as you consider doing commercial real estate. So, AJ, tell us about some more of the intrinsic value, some of the upgrade opportunities you've seen at some of your self-storage or other facilities.
So first of all, I can't tell you guys how happy this makes me, because when I got into self-storage, nobody talked about self-storage. Like, I wasn't ever invited to speak anywhere. The National Storage Conference.
That had nothing to do with self-storage.
So, no, it doesn't. The only reason I got it here is because of Jay. The National Self-Storage Conference, there's more people in this room today than I think was there at all. In fact, I was more teased, and we didn't even tell people we bought storage because they looked at us weird and asked, why are you a slumlord and no junkyards? So, how times have changed. It just makes me so happy. I'm so glad to be here with all of you. Okay, so one of the things that we focus a lot on is, a lot like Tyler was saying, we're looking at the intrinsic holes. So we can see it through operations, but we can also see it through these other asset classes and they're valued. One of the things that we did is we started to notice that when we had these big empty Kmarts and everything that was sitting around, we knew that that model was dead. It was gone. Nobody was coming to buy 200,000 square feet. And it wasn't that retail was dead and gone. Retail had changed, right? And so they were trying to sell these at the value of the income that the Kmart paid. Well, that was gone now. So how do you value real estate if you don't have that income coming in? And that was the question. And the answer was, nobody had any idea. All they knew was that money's gone and it's never coming back and nobody's now paying you. So all of a sudden you had something that was worth $30 million. And everybody's like, it's worth $30 million. And they're like, well, this tenant will pay you $5,000 a month or something for it. So now it's worth $5 million or whatever those numbers were. And we looked at it and we said, well, actually, that to us is worth somewhere around, 50, 60 million. Because the revenue per square foot I can get inside that building is X, which is $3-4 million a year. And so we went to start to talk to these people, and we are not buying it what I can do, I'm buying it what is. So we end up buying it for $8 million. We sold the land off to multifamily developers, and they developed huge apartment buildings. So we were in it then $3 million. We built it out for $8 million total, all our cost, everything done. We blew walls, we built roads through it, we hardwired wires into it and made the first automated facility that was actually, you could use from your cell phone, so the doors would unlock, everything else like that.
Didn't you cut it in half?
Yeah, we did.
Why?
We cut, why did we cut the building? So it was too big. So we cut it up. Now we've expanded it. So we opened up our expansion on it last year. This was 4 years ago, but now we built it out. And then from there, we got revenue per square foot that was probably higher than the Kmart even paid at the time. but we put $2 million into it. 3 years later, we had 5 offers at over $30 million. The average was $34 million. So we made $28 million in roughly $4 million because they couldn't see the differential in that intrinsic value. Everybody was solely looking at the extrinsic. There was no comps, and the comps and the usage they couldn't compare it to. So all of a sudden, this box was worth theoretically nothing but the land. And that's what they sold. This was on the exit of a major freeway, one of the fastest growing markets in the United States. We just did that again, same thing, major exit, and the last exit going into Boise, Idaho, one of the fastest growing cities in the United States, 5 acres, massive office building. That office building was a newspaper company. The newspaper company was going bankrupt because they're news, and that building then was right during COVID. Everybody's like, office space is dead, nobody's buying it. We bought the 5 acres, last exit into the downtown area with this massive multi-story building, lots, everything, for $3.5 million from the bank because nobody would touch the real estate because office is dead and it's never coming back. And so we're currently building out and expanding that. I mean, the whole cost to us is probably around $15 million, I think. And easily that will be worth $30+ million on that one asset. And we're able to do those things because of the idea of that revenue that we can generate from this asset. What is our actual cost going in? Now, those are big numbers, but we see this in small spaces. So, when we're looking at it, I can't tell you how many small strip malls have one, section that's 20,000 square feet attached to it. And nobody knows what to do with it in that town. And there's little one-box retail centers all over the Midwest that are isolated, one box that housed whatever it was that is sitting empty and nobody knows what to do with it. So that's a play that you can look at as long as you're not looking at the normal real estate. Oh, is this so? Because what people are looking at is retail going to go up in value? And everybody's like, no. Oh, then I shouldn't buy it and I shouldn't do it. Once again, they're looking at the asset like a stock, like it's being traded, not like a business and what they can do with it. And so the market misses these absurdly enormous flaws that to me seem so ridiculously obvious, but they just are viewing it in a real estate mindset.
And it's not the market that's missing it, it's the people that own the properties.
Yes.
Let's not abstract it out to there's this amorphous market that's not seeing no, it's people like Paul and Tyler and Britt and AJ and me. We go into a place and we see something different than the last owner saw and the owner before that. And the 100 people that are bidding against us, they don't see it either, or they'd probably be bidding more. And so it's really important for you to understand that you have power, and it's not a vague, amorphous market thing. If you're smart, and I don't like the word smart. If you're
I'm not smart.
Yeah, and smart in different ways. If you're creative and you can think outside the box, and you don't fall into this trap of thinking, I'm buying this property, it's been run like this for the last 100 years, therefore it has to be run like this for the next 100 years, don't fall into that trap. Be more creative than the last person and figure out how you can generate value in ways that the last person didn't figure out. And if you can do that, you're going to be successful in this business.
In fact, it's the opposite. The smart people are the ones that miss it because they think they know. No, I know because I've seen the data and retail's going down. It's idiots like me that say, I don't know anything about that. I don't do retail things, but I know that I can make X amount of money in this little box, and that has a margin of 50% that I can yield on my money on cash flow alone. So I'm not smart like you guys, but I know I can make a 50% on my money. So
yeah, I mean, almost every building's the same, right? It's 4 walls and a roof.
Yeah.
I mean, that could become pretty much anything. And the great thing about these office conversions is you've got several different product types that you can have on this one lot, right? You've got your indoor climate-controlled self-storage, which is very expensive to build new construction. But guess what? Converting an office building, you've probably got HVAC units there already. You can do traditional outdoor storage. You could do, industrial outdoor storage with, a fenced-in lot, not do anything else. If you got 5 acres of land, you're not going to need all of that parking anymore. I mean, you hardly need any parking for self-storage at all. So there's a lot of opportunities to convert these properties into something else. Of course, look into the zoning. Make sure that it is permitted by the municipality that you are working in, that it can become self-storage or become industrial or retail or office, whatever you're looking at doing. But sometimes it might be worth rezoning if you've got to go through that process, if you can get a good enough deal on it.
So I jokingly mentioned earlier that I started out as a failed multifamily syndicator. I actually wrote a book in 2016 called The Perfect Investment about multifamily, and humble title, right? And we actually found that people were overpaying for multifamily. They were using short-term debt. They were using floating rate debt, and nothing's wrong with that, any of that individually, but together it was a disaster waiting to happen. So that's when we pulled back and decided we can't compete with people willing to pay 20 or 30% more. Jay, you've written 5 books. You've been around a long time. Tell us a little bit about what's happened in multifamily. By the way, commercial includes multifamily over, 5 units? Tell us what you've seen as far as pricing, what's happening now, maybe some stories you've heard about the multifamily realm these days.
Yeah, so when we talk about commercial real estate, it's really tough for any of us to kind of talk about real estate, whether it's commercial or residential, on a national level. We all know this. Anybody that's been in real estate knows that what's happening in Northern California is going to be different than what's happening in Texas versus Connecticut versus Chicago, whatever. So every market's going to be different. But in broad strokes, what we've kind of seen over the last year and a half, and the reason year and a half is kind of important is because everybody knows what happened after 2008. Things dropped, but then things started going up. We had this little blip in 2020 at the beginning of COVID, but then after that blip, up and up and up again. And it wasn't until March of last year when we started raising, and I had nothing to do with it, I promise. The Federal Reserve started to raise interest rates, and everything sort of started to break, at least in the multifamily world. And so what we've seen since last March is, and I talk about again, this thing called cap rate, which is the multiplier in the market. A lot of people are talking about values dropping precipitously over the last year and a half. The reality is we saw a big drop between last March and last August. So basically summer of 2022, we saw cap rates go up a whole bunch, which means values went down a whole bunch. In the markets that we're in, 20-25% value drops. That said, between last August and today, we haven't seen nearly as much of a continued downturn. Things have kind of settled out. Now, some people suggest that maybe that's not really the case because there's so few transactions right now that we don't really have this thing called price discovery. We don't really know what things are worth, and maybe things are worth less than we think, just because nobody's selling or buying anything, so we don't know. But in my opinion, the bulk of the downturn that we saw in multifamily occurred last year as soon as interest rates started going up. Now, despite the fact that values dropped considerably last summer and kind of leveled out after that, I think there's still a good bit of distress that we're likely to see moving forward. So between interest rates, between the increased costs of these things called rate caps, which are insurance policies against interest rate increases, with refinances coming up, and when values drop, it's hard to refinance a property without having to bring cash to the table because your property is worth less. The banks aren't willing to loan as much. So there are lots of risks right now that as time marches on and interest rates are high, in the multifamily world, a lot of things were done 2, 3, 4 years ago, and a lot of the financing that we do in the multifamily space is 2, 3, 4 years in length. And so what we're going to see is over the next couple years, as these loans start to come due, as interest rates start to reset, as these insurance policies start to terminate and need to be put back into place, what we're going to see is that we're going to see a whole lot of multifamily owners who are starting to hit distress points. Now, I don't think values are going to drop much, but I do think we're going to start to see more transaction volume because we're going to see a lot of sellers who are desperate to either get out of a deal or bring in partners or more equity to help them survive for a couple more years until interest rates do come down. So my take is in multifamily, and keep in mind, everything works in cycles. Every part of the economy, every part of business works in cycles, up and down and up and down. And that continues forever until there's some catastrophic event where the asset class goes away. And we see this in the big economy. The economy goes up, we have recessions, it goes down, expansions, it goes up. And we're going to see that over and over again until one day our economy collapses, our currency loses value, and it will happen at some point, hopefully not for a long time. But until that happens, up and down and up and down and up and down. And it's the same way in multifamily, it's the same way in self-storage, it's the same way in hospitality and resort. It's up and down and up and down. And so, yeah, multifamily is struggling right now. Other assets may or may not be struggling right now. But if you can survive a couple of years, it'll go back up.
Jay, I'd love to dive further into multifamily with you, if you don't mind, to hear more about what is the 5 to 10 year outlook on multifamily deals. Because I mean, just setting the stage, like for the last 11 years, syndicators have been hitting every value add opportunity they possibly could, right? And now we're 3, 4, 5 turnovers into it, where somebody bought it, renovated it, flipped it to the next guy who bought it, renovated it, flipped it to the next guy. And it seems to me like I'm sure there are still some value add opportunities out there, but they're few and far between, and there's a lot of sharks going after that blood in the water. I mean, is the future of multifamily investing right now, is it just opportunistic, waiting for these guys who are in distress to come in and get a deal and then kind of ride the 3 to 5% rent bump wave, or what does that look like?
Yeah, so if you look back 100 and some years, what you'll see, 120 or so years, what you'll see is that if you look at this inflation line and you look at this housing line, with a couple blips here and there, you'll see those two lines kind of move together. And in early 2000s, just before 2008, we saw inflation kind of going like this, and we saw residential or housing go like this. But then after 2008, we saw it come crashing back, and those two lines were moving together again. And so after 2013, we kind of saw that again, where inflation kind of kept going like this, and then we saw that jump away from that trend line in housing again. And so right now we're kind of in that 2004, 2005 space, where these two lines that for 120 years kind of moved together, inflation and housing, they've broken apart again, and housing is soared well above inflation. One of two things can now happen. We can either have a 2008 type event where that line comes crashing back down, housing falls, and the value of housing drops back down to the inflation line, or, and it could be a combination, or housing just kind of stays steady for a while inflation continues to go up, and then those lines meet somewhere in the future, 2, 3, 4, 5, 7 years down the road. I suspect that we're not going to have a 2008 type event where that housing line comes crashing down. I suspect that both in residential and multifamily, we're going to see housing kind of flatten out for the next 4, 5, 6 years, and the inflation line is going to kind of get a little bit steeper. We're going to see more inflation than we've seen, and in 4, 5, 6 years, we're going to see those two lines kind of merge again, and we're going to be back into what we consider a normal housing economy. So I don't think we're going to see tremendous growth over the next 4 or 5 years, but I do think that there's going to be opportunity, and I don't see a crash coming, and I do think 5 or 7 years from now, we're going to be kind of back at the start of the cycle.
So this is for anybody. I read, I don't have the number in front of me, but I read that there was a 6 or 7 or million unit shortfall, or there will be by the mid-2030s. How is that going to affect, the multifamily and single-family housing now and in the next, say, 12 years?
I think that, first of all, we have been building, our shortfall for putting houses on the market since 2008 has been astronomical. I don't think people really understand this. In the United States, between just our birth rate, growing population, immigration, and people coming of age, which the millennials are the largest generation ever in the United States. Ever. They're bigger than the baby boomers by actually a significant number. And when the 2008 crash happened, for all the millennials that like to think that baby boomers have it so good, you didn't get wiped out. It was the baby boomers that got wiped out. You had it good. You had no debt. You coasted through that recession. But you're coming of age now. They're now having kids. They're having everything else. They don't have houses. They're gone. They're just gone. Baby boomers lost everything. They all need houses. Funny enough, that's the same generation that said buying a house is stupid after 2008. That said, oh, everybody's dumb that buys a house. Then they all grew up and now they all want homes. And this gap, combined with the population increase and the coming of age of this ginormous generation, has led to an absolute, I mean, it's devastating on the price of houses. Demand is so far surged that when we had interest rates that went from 3 to 8, you essentially cut in half your purchasing power. Housing prices didn't move. We've never seen anything like that before. It should have devastated the market, and it didn't, and it won't for a couple of reasons. Demand, but nobody is selling their homes. Why? Because they're all locked into 30-year mortgages at free money. And so even if they were going to move, you can rent your house out. So all of a sudden now, the cost of people owning the homes is the cheapest ever, and the cost of people that need to buy homes the highest ever. So nobody's selling homes. We have an undersupplied market that is historical in proportion. And we have the most, literally the most ever affordable home ownership in the United States history for people that own homes, combined with the most unaffordable for those that are trying to buy. And so this creates this stagnation in the housing market where you can't entice, the market's can't recorrect itself, right? And nobody's building homes. So that's the other problem. Higher interest rates leads developers and people to shut off. We can't afford it now. So you're actually exasperating the problem.
Just to touch on the very last point that AJ just made, on the supply side, about a year or two ago, we started to read all these headlines that all this building was started in multifamily. We were going to see all this millions of units coming online over the next year or two, and that was going to cause prices to drop and there just to be a glut of inventory. And I remember a year or two ago, my partner Ashley looked at me and said, everybody that's saying this is nuts, because yeah, everybody's talking about building, but what happens in the real estate world, what happens in the multifamily world, what happens in the development world is you talk about building, and some of it is going to be built, but never is all of that inventory actually going to come online. And here we are a year and a half, 2 years later, and she was absolutely right. So as of last month, housing starts, which is basically the number of units that get started to be built, was at the lowest point since 2020, meaning developers have all pulled permits, they've bought land, they're ready to build, but they're not actually starting development. Why aren't they starting development? Well, as AJ said, interest rates are really high. So to take out construction loans, now it costs a lot more to take out a construction loan. Fewer buyers. So with fewer buyers, the margins are lower. So you don't not making enough money to actually pay those higher interest rates. Inflation, labor costs are up, material costs are up, and the uncertainty. Developers don't necessarily want to go full steam ahead when they don't know what's going to happen a year or 2 or 3 from now. They're reading the same headlines we are, that all these builders are building all this inventory, and now they're suddenly scared because I'm going to have units coming on in 2 years, and there's going to be 10,000 other units all around me coming on in 2 years. And you know what? They all stop building because they all hear it and they all believe it. And so, yeah, we talk about all the supply coming online, but the reality is, and I'm not saying this won't change tomorrow or next year, but the reality is, as of today, all this talk about supply coming online that we've heard over the last year or two has been a complete red herring, and we're not seeing any of that, or not seeing much of that supply coming online.
Yeah, we're in pre-development of a little over 600 affordable housing units in Nashville, and we're doing a documentary right now on the affordable housing crisis because it just keeps getting worse. And the thing that we've found is, in the conversations that we've had, we can't build ourselves out of this problem. And it's not that we are not physically capable of doing it. It's that the government doesn't give enough grants. You can't, pay market rate for land, pay market rate for construction and development, and then rent your units out at affordable rates. It doesn't work like that. So you have to get subsidies. And then there's so much competition going for that subsidies. I mean, we just had one developer that fell out on 63 units because they didn't qualify. It's a really interesting market right now. I mean, if you're interested in affordable housing, it hands down, it has the highest demand of any product in commercial real estate, no competition whatsoever. Every single buddy of mine that delivers a 250 to 350 unit affordable housing project is 100% leased the day that they deliver it. There's no other product out there like it. The problem is just getting those projects across the finish line, which is next to impossible for a multitude of reasons. I mean, even if you have the government's help, a lot of these sites, you've got to go through a rezoning process. And your politicians love to say out in public, yeah, we need affordable housing for our people. And then behind closed doors, okay, well, we're going to do affordable housing here. We need 300 units. We need density for that. I'm not doing that. I mean, you can't get anybody to actually work on the problem. Everybody just loves to talk about it. But yeah, I don't think that we can build ourselves out of that issue.
That's interesting. We have seen the same thing in mobile home parks. It's very hard. You know, the Biden administration has said we're going to give grants and we're going to try to get more manufactured housing, but it's very hard to get an approval. I mean, there are, you know, it puts a burden on the school system, a burden on the public sewer and water and roads, but it's not, mobile home parks aren't paying a lot of taxes. So if you can figure out a way to develop a mobile home park, or if you can buy one, sort of like you said earlier, Tyler, where you can get extra acreage and try to get approval on that, that is a great way to go. In fact, we are investing in one with my favorite syndicator out there who has in West Virginia, has one of the fastest growing counties in West Virginia because it's close to DC. He was able to get approval to add 70 mobile home sites. And so that's a huge increase in value. When you use Jay's formula there, that increases the value of this park probably $5 or $6 million right there. And so that is a great affordable housing play. Britt, I'm getting involved in Twitter at Paul Moore Invest. And just kidding. I am amazed at the way some people are using Twitter and Instagram and LinkedIn and to raise money and to go from sort of being a beginner to really making a name for themselves. There's some well-known people on Twitter who are doing that. Britt, you're the expert of any of us up here. How do you do that? How did someone go about starting that process?
Yeah, and it surprised me too. I never would have thought that through social media I'd be on this stage or have incredible partners and, you know, meet all these mentors and all this stuff. So getting started, it is a lot of work, right? To put yourself out there online, but the opportunities that come through are amazing. And the deals that I have got, they come to me. I have not had to look for a deal in years because it's opportunities that are always flowing to me, which is pretty cool. But it's a lot of work and it's been a lot of years of being very consistent. So it's like anything, you have to really just focus on the long-term, bigger picture of it. And so I just had a plan, you know, every Wednesday and every Sunday I would make a post and I just kept it with that. And now I have a great team that helps me post regularly and go on all these different platforms and all that as well. But you just have to get started at some point and see that bigger picture of the opportunities that will come through it.
We're in sort of a pullback, sort of a downturn right now. Do you think this is a uniquely helpful opportunity for people who want to get into commercial real estate?
Yeah, I mean, first off, you're not alone, right? Like, I mean, even the big guys have trouble getting deals done in times like this. I mean, we just dropped a 79-unit boutique hotel that we've been working on for a year because I couldn't get financing terms that I wanted. And we weren't going to force that deal through, so we dropped it. I mean, we lost money on the deal, but that's just part of development. You know, it's better to lose that cash now than to file bankruptcy in 12 months. So you got to know when to cut your losses. I think that times like these are what create really special real estate investors because you have to get creative. It's always like I go back to when I first got started in sales. You know, they give you this sales template, your cold calling script or whatever it is, right? I mean, how many people have read through that and been like, I feel so awkward saying this? That's because it's somebody else's formula. Like, it's not your formula. And I feel like so many people try and look at commercial real estate or real estate investing in general, and they say, no, 1 + 1 = 2. Like, that's what I have to do every single time. And it's not true. You got to get creative, find your own way, because 1 + 1 will = 3 when you figure that out. Like, I have come up with some of the craziest deal structures that would, you know, that blow my mind sometimes. I'm like, how is this going to work? But it does. And it's because I'm just sitting there listening to the seller and trying to figure out what they want. What do they want? Or what are you going to use this money for? Are you going to 1031 exchange? No, I don't want to deal with that. I want my cash. I'm more on cash flow. Okay, well, have you found any other deals that you're going to throw this into? No, I mean, nothing out there is a really good deal right now. Okay, perfect. Let's talk about seller financing, because I'm going to give you a way to where you can secure this property. You can foreclose and take it all back, plus all the cash I gave you on the front end, plus every interest payment I've made if I ever default, and you'll make monthly cash flow. You don't have to worry about a damn thing. So, seller financing right now is the best way to be getting deals done. I mean, we're not looking at anything right now where I have to deal with a traditional bank, because it's not worth the headache. And most of these banks right now are either tapped out, they're scared, or they just offer terms that you cannot accept. It doesn't make there's no point in buying the real estate because your investment returns are going to be so low, it's not worth the risk. So seller financing is great.
So it's kind of an equalizer for people who are newer, right? Because they can maybe convince somebody with a mobile home park or whatever to give them seller financing.
Oh, of course, yeah, because the seller's not going to look at your credit. They're not going to care about your assets. I mean, they will to a certain extent, right? Like we'll provide proof of funds or whatever this seller wants, we'll give it to them. I mean, we've done this a number of times, and it works like almost every time. I usually go into a deal and say, hey, once we'll probably make an offer that includes seller financing. That's how we got that deal. I made him an offer, $800,000 cash. I'll close in 60 or 90 days. $900,000, but you carry $500,000 at 5% for 5 years, interest only, and we'll close in 60 days. It's something like a lot faster. So you kind of do this binary offer where they tend to not negotiate and kick back on you. They just select one. The great thing is both of them work for you, right? You put the two offers together, so it's a great way to just help get deals done.
I want to touch on this real quick because I think this is really important. Saying it is not that it's an equalizer. Right now is the best time for somebody that's trying to get into commercial real estate to start. The best time. And here's why. How many of you have $10 million in cash sitting in your bank account? Raise your hand, please.
There's a guy in the back.
Right? Is there somebody?
Everybody go talk to that guy.
Perfect. So if I could grab you afterwards, if we could talk and hook up, that'd be wonderful. Okay. When you guys are in competitive markets where capital is cheap, it is a money game. It is a spread between the cost of money and cap rates, and money people win. Okay? They move faster, they invest more, and they outbid you. But guess who else wins? The seller. Today, money people doesn't work. The whole entire model just broke down. So now all of a sudden, sellers, guess who they don't have to sell to? They can't sell to money people. And guess what money people don't do? Work. They don't. They allocate capital. Nobody's going to go sit down with an owner and negotiate seller financing. No, what they do is they allocate capital. They hire big institutional people to run and do the deal for them. They take the spread and they take their cut, and boom, I'm making millions. Great game for those of them that can play it. But for everybody else, that doesn't work. Today, that model's gone. The seller now has to actually look at alternative options. You could actually see in the markets, the bigger deals are getting done less. The smaller deals are getting done more because the big capital gain goes to the big deals. That doesn't work. They can't get the price. And the big deals, guys, they don't sell unless they can max it out because they're also institutionalized. All the small deals, though, these are mom and pop owners. These are individuals. These are families. And guess what? They sell for real reasons. I'm retiring. I actually need the money. I either have to put money into this or I have to refinance it. So when they go to sell, the real sellers, not just price sellers. There's a big difference between those two things. So we're going out and we're negotiating and we're working with them. When we got started in storage, banks didn't like storage. So guess how we bought? Seller financing. And guess how sellers sold? Seller financing, because it was that or you didn't sell. And so when you guys are in the market today, you now have cap rate expansion, which Jay talked about, right? And now you have sellers that have to work. They don't have everybody competing over it. And they'll all of a sudden get rid of your biggest hurdle. The bank can't get approved. Well, they don't have a buyer that can. So it is actually the greatest opportunity for individuals and people starting out to get into commercial real estate. And it's funny how people see that backwards. Oh, I wish I would have gotten into it 2 or 3 years ago. You wouldn't have bought anything because you would have been bid out and everybody would have moved faster. Why? Close in 30 days, full cash offer, no due diligence period, and I'm going to pay you a 4 cap. You can't and shouldn't play that game. Today, I'll close in 250 days because I got to raise the money. I have all these contingencies on it. And by the way, you're going to be the bank. And sellers are like, okay. So all of a sudden now, you have an opportunity that, guys, doesn't exist for very long. The moment interest rates go back, that window's gone for you, and you're now playing the money game again.
Yeah, and adding to what AJ's saying there, there's a lot of seller fatigue right now. There's so much seller fatigue because, you know, they've been trying to sell their property for the last 12, 18 months. They've been under contract once or twice. Both contracts have fallen through because they couldn't get lending, and sellers are tired of it. I mean, they're so tired. And so if you come in and you say, look, I can basically guarantee that we're going to close because you're going to be the bank. Tell me when you want to close. They're probably going to accept that offer because they just want it off their hands.
So we've got about 30 minutes left. We're going to go to some Q&A here in a few minutes, so get ready for that. But we're going to quickly go through one more thing. So the last third of my book on self-storage provides 7 unique paths to get into commercial real estate, because I get this question a lot. So those paths are, number 1, stair-stepping, like buying a small facility, maybe a 50-unit self-storage, fixing it up, renting it out, improving it, and then selling it, moving up to a 100-unit or multifamily or mobile home park or whatever. Path number 2 would be to be a capital raiser. You got to be really careful with the SEC. If you do this, you need to be a partner in the deal. Path 3 would be to be a deal finder. Go out and find deals and bring them into a partnership. Path 4 would be if you're, you know, a retired NBA or NFL player or won the lottery, you've got millions of dollars at your disposal, build a team and just go big. Path 5 would be to get a job. Now, a lot of you don't shout me down because I know you're here because you don't want a job, but for some people, like the guy I know who was making $120,000 a year as a mortgage loan officer, he took a 50% pay cut to be a property manager at a self-storage facility because he wanted to learn the business, and he did. Path 6 would be to find a coach or mentor, and that's a great path, a paid coach, maybe be able to partner with you someday, or maybe you could raise money or bring them deals. But a paid coach or a mentor where you just do stuff for free for them and they grow to like you and you end up joining their team. And then path 7 is to be a passive investor. And that's usually for accredited investors who've got a busy day job and they need to find a great syndicator or fund to invest with, but they maybe stay involved and get to know the business a little. So of those 7 paths, what would you all say, or other paths, what would you say is a great way to get started? We'll start with Jay and come down. What would be a like mentoring, coaching, deal finder, money finder, whatever?
So I originally went down path number 4. I wanted to be a retired NBA player. That didn't work, but I kept going. So I love that breakdown. I'm not that smart, so I actually bucket it. We in our business kind of bucket it a little bit differently. We talk about find, fund, and run. And so we look at it in those 3 big buckets. Are you going to find deals? Are you going to be a capital raiser and deal with funding deals? Or are you going to be an operator who actually works on operating the deals? And I think all 3 of those, and obviously all 7 are great, but in broader buckets, I think those are kind of the 3 big ways to look at it. Are you the type of person that can network with brokers and sellers and other people that can help you find deals? Are you an extrovert? Are you a good communicator? Are you a good negotiator? Are you creative? Well, finding deals might be the path for you. Funding, so raising money. A lot of people think you need to be an extrovert to raise money. I'm a huge introvert. But I focus on the fundraising in our business. And fundraising really is about systems and processes and building relationships and building trust and communication and finding the people that can help fund your deals, building relationships with them, getting them to trust you, and then partnering with them. And then finally, and this is the one that I think is often overlooked, but is probably the best way to break into this business right now because it's so often overlooked and so many people don't focus on it, is operating. So being what's called an asset manager. In commercial real estate, we have this thing called an asset manager. An asset manager is basically the CEO of the project. It's their job to figure out how to bring the income up, how to bring the expenses down, how to make sure the renovations that you're doing are getting carried out in an efficient way, that you're staying on budget, that you're staying on schedule, that everybody is doing what they're doing. Again, the CEO of the project. If you have these types of skills, if you're a good organized person, you can lead, you can manage, you can be that CEO, then going the operational route, I think, is the best way to break into this business. And when we talk about finding funding or running, a lot of people think they need to start their own business in commercial real estate. They need to go out and do everything themselves, hire people. What I would suggest to everybody out there that's looking to get started is don't go that route. Go find an existing business. Go talk to anybody up on this stage. Go talk to anybody out here that already runs an existing commercial real estate business and say to them, do you need help finding deals? Do you need help raising money? And as Paul said, be careful about the raising money piece because there's lots of laws around that. Do you need help operating your deals? And pick the thing that is the thing you can do best. Find a group that needs that specific help, and then insert yourself into that group. And that's how you can learn. That's how you can get good at whatever that one of those 3 things or 7 things that you want to do. Don't go out and try and do it yourself to begin with. Find somebody else that needs your skill set. Insert yourself into their group, get paid a salary, get paid a commission, get some equity in the deal, whatever it is, improve your skills, and then in a year or 2 or 5 or 10, whenever you think you're ready, that's when you go out and you start doing it on your own.
I have a few thoughts on this. The first one is commercial real estate, you guys, is a team sport. I say this all the time, and I really mean it. We were having problems with a lot of fundamental things that real estate people have because we did everything ourselves, everything, for a long, long, long time. Long, long time. And there comes a point where no matter how much we did, I was working 2 full-time jobs. We were capped. And so I started to think about, well, okay, how do we work with others? How do we partner, with others? Is that something we could explore? And I wasn't exactly sure who, how, or whatnot. So instead, I just turned to giving value. And so I started a podcast. I wrote a book. And this was at a time which I was like, I don't know if anybody wants to even hear anything about storage at all. All of a sudden, the podcast immediately just skyrocketed. It's the largest in the whole space at the time. And I think there was maybe one that was even out there. And we just kept giving value without even an ask. There was no ask. There's no seller, no nothing. I wrote a book. Here you go. Buy the book. I gave away everything for free. I gave all of my secrets, everything. I'm like, this is exactly how I do everything. Because I thought, all right, then if you know, then you can partner with me and help. And then people brought me deals, brought me capital, right? And I talk a lot about when you're starting out, there's 3 things. You learn, churn, and earn, okay? So the first thing is you got to learn the thing. You are of no use, right, if you don't know whatever you're doing. If you got to find deals, if you want to bring deals to the table, what do you want? What is that person that you want? Like Jay said. Then you churn, meaning repetitions, guys. Real estate is an act of repetitions ad nauseum. We underwrite deals at repetition. We talk to brokers. We look at deals. We ask for money at repetition. You're not going to get it 1, 2, 3, 4, 5, 10 times. You'll get it after your 100th time. So first you learn the thing, then you do it ad nauseum. Churn. Then you earn. Then through that process, you find good deals, you find capital partners, you find all of those things, and you can start to then make a deal. We don't find deals in commercial real estate. We make them. So as you're going through this, you have to try to condense your time. And that's when it comes, first of all, you find partners that you can work with, or then you find people you can learn from. And so for me, I'm like, I'm going to put everything out so I can condense people's time frame so then they can turn around and give me what I want. Bring me a deal. I'm going to tell you everything that you need to know, and I'm going to try to get it so it doesn't take you 15 years like it took me. Bring a deal. Let's be partners. Go get capital. Here's exactly what we do. Here's exactly what we want. If you have somebody that wants to place money, go get them, and we'll be partners. So then for me, that's the whole thing. I was trying to condense people's learning time, do repetitions to even show you how, right? And then they earn, and we all earn. So that's really what it is. It's partnership, right? And it's working with others, but you have to learn it. And learning takes time, okay? You also have to do it. And then the rewards come. Try to condense that time through experts and through things that you can do as quick as humanly possible.
Yeah, and I really agree with condensing that time down, which the mentorship one spoke to me a lot, because being in proximity with people that think way bigger than you, it really happens way faster if you're able to be in that proximity. And probably the last year, I've spent over $100,000 in just coaching and programs and people that I could learn from and then get me to where I want to go so much faster. So I think there's a lot of power in that, and there's so many different ways you can do that and be in that proximity. But like AJ was saying, just bringing a lot of value to the table and working with people that you look up to, I think there's so much to that.
My knee-jerk reaction is all of them. As a real estate investor, look at yourself. I mean, this is how I call developers, right? You are the conductor of the orchestra. You don't have to play every instrument. You don't have to know the ins and outs of every instrument, but you got to know how it works and how they work together, right? It's the same in real estate. If you're good at finding deals, but you don't know anything about raising capital, you still want to know something about raising capital if you've got a partner that's pulling all of the money together, because they might try and pull something over you. Unfortunately, real estate is just one of those industries where people try and take advantage of you at every turn, and the more that you know, the more you can protect yourself. I sold a deal that I bought in 2021. I sold it in June. Bought it for $1.8 million. We sold it for $4.6. So, less than 2.5 years. Bought a deal last year for $5.6 million. It just appraised last week. We haven't really done much. It's been a year. It's a really big project. We signed one lease for like $7,000 a year. It appraised for $12 million. That's all from finding deals. That is my skill set. That is what I'm better at than anybody else. Like, I will fight you on that. And it's because I got started as a commercial real estate broker. I mean, for 10 years, I've been looking for deals. I've had to do this no matter what for all these other people. Then I get to start doing it for myself. And, once you know how to really find a deal, this is my obvious biased perspective, everything else starts to fall into place. You find a hell of a deal and people start to learn that you are the person that finds really good deals, they're going to want to throw money at you. They're going to want to partner with you on deals. Now, I think no matter which path you take, I highly recommend finding deals, because that's a very, very valuable aspect of the project process. You should find a mentor or coach. I mean, I think I've had so many people along the way that have helped me get to where I am. The problem with all of this, we can sit up here and have a 90-minute talk. You can listen to every podcast in the world. You can read every book on commercial real estate. You'll get the knowledge and you'll know the words, but until you actually go through the process, you're not going to understand what it's actually like doing a commercial real estate investment. You just have to do it.
Thank you so much for being here.
Thanks, everybody.